The Essence of IAS 8: Accounting Policies, Changes in Accounting Estimates and Errors. Coming to accounting policies. What are accounting policies? Accounting policies are specific principles, bases, conventions, rules and practices applied by an entity in preparing financial statements. In absence of an IFRS that specifically applies to a transaction, other event or a condition, management shall use its judgment in developing and applying an accounting policy that results in information that is relevant to economic decision-making needs of users and reliable, that means represents faithfully, reflects economic substance, neutral, prudent and complete. In making judgment, also consider in the order of importance the IFRS dealing with similar and related issues, the definitions, recognition criteria and measurement concepts outlined in the conceptual framework, and the most recent pronouncements of other standard setting bodies. An entity shall select and apply its accounting policies consistently for similar transactions, other events and conditions, unless an IFRS specifically requires or permits categorization of items for which different policies may be appropriate. There are some examples of accounting policies like inventory valuation method, valuation of fixed assets, valuation of investments, treatment of leases, historical or current cost accounting, etc. Changes in accounting policies. An entity shall change an accounting policy only if the change is required by an IFRS or results in financials providing reliable and more relevant information about the effects of transactions, other events or conditions on the entity's financial position, financial performance or cash flows. It must be noted that the following are not changes in accounting policies. The first, application of an accounting policy for a new type of transaction, other event or a condition, and application of a new accounting policy for a transaction that didn't occur previously or was immaterial earlier. The change in accounting policy is applied retrospectively by adjusting the opening balance of each affected component of equity and restating comparatives. Coming to changes in accounting estimates. Changes in accounting estimates means adjustments of carrying amount of an asset or liability or the amount of periodic consumption of an asset that results from the assessment of the present status of and expected future benefits and obligations associated with assets and liabilities. For example, allowances for doubtful debts, useful lives, inventory obsolescence, warranty obligations, net realizable value of inventories, depreciation expense, etc. A change in accounting estimate may affect only the current period's profit or loss or the profit or loss of both current and future periods. A change in accounting estimate may be necessary if new information arises or if circumstances change. The change is applied prospectively, so no prior period adjustment is required. Coming to prior period errors. Errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that was available when the financials for those periods were authorized for issue or could reasonably be expected to have been obtained and taken into account in the preparation and presentations of financial statements. They may arise from mathematical mistakes, mistakes in applying accounting policies, frauds, oversights, misinterpretation of facts, etc. Material prior period errors should be corrected retrospectively in the first set of financial statements authorized for issue after their discovery by restating comparative amounts for each prior period presented in which the error occurred. And if the error occurred before the earliest prior period presented, then restating the opening balances of assets, liabilities, and equity for the earliest prior period presented. And including an adjustment to opening equity as the second line of statement of changes in equity.